Marico is today valued at nearly 70,000 crores at last count. It pays out dividends to promoters in the range of 300 to 400 crores a year. How do you deploy that kind of capital?
Initially, it was 90-10, 90% listed, 10% unlisted. The allocation has changed. So from 90-10, we moved to 80-20, we moved to 70-30, today we're at 60-40.
So 40% goes into unlisted assets today.
Yes.
How much do you think is the amount of money it needs before you should do this?
Yeah, so I think, it just really doesn't make sense when you do it. It has to be above 100 crores. Most promoters today are running their own businesses.
Yeah.
I think the question that I actually ask them is that, okay, fine, how much time are you willing to invest?
So this is investing or running your portfolio as a full-time activity. And since you're an active investor yourself, how do you evaluate funds?
What emotional need are you addressing, or what pain point problem are you solving for the customer? Brands take time to get built. And we've seen that in Marico, in Kaya, in Soap Opera, in Pure Sense. We've seen that brands don't get built overnight. For that, you have to have long-term patient capital. And that's what we are.
What does it take to multiply your money 35 times with an investment in Nykaa and 50 times with an investment in Mamaearth? Today, I have with me one of India's most prolific D2C investors, Rishabh Mariwala, who is a managing partner at Sharrp Ventures, the Harsh Mariwala family office, and a director on the board of Marico. With him, I talk about what it takes to succeed in D2C investing and how he has built one of India's most well-known family offices. I hope you'll enjoy this one. I'm Sandeep Jethwani, the host of the Create Wealth podcast and co-founder at Deserve. Rishabh, one of the most interesting things about your own journey was Soap Opera.
That's right.
Which is where you yourself were a D2C founder.
Yep.
How did you decide? And honestly, you come from a very successful family.
Yep.
It would have been a tough decision on whether to go into the family business or to do this. Why did you choose to start Soap Opera?
No, I think, thanks Sandeep. I think that's a great question. And I've also, everything is clear in hindsight. And I've asked myself that same question. Why did that? And actually I have a lot of clarity about it because it was a defining moment in my life.
Mm-hmm.
I think that was the single largest defining moment in my life was when I actually went through the journey of being part of the business where I'd come back from the US
Mm-hmm.
and I was working for 3 years. I worked in Kaya. Kaya that time was part of Marico, and I worked on different facets of Kaya. And at Kaya, I realized that as a member of a family where the organization is professional, which is the case with us, that journey is very different for every family member who is joining their family business. A lot of it is dependent on the culture of the organization.
Okay.
In my case, I went in, I was a fish out of the water
Mm-hmm.
because I think there was no communication whatsoever to the members saying that, hey, this is, yes, Rishabh is part of the family, but this is what he's doing. So no one from junior, mid or top management really knew what I was up to. So it was a little bit, I think it's not a little bit, it's very ambiguous for everyone, including me, because there was no clear path.
And would people tread carefully around you, knowing that you are an owner? You work there, but you're also the owner of the company in a way?
So let me put it this way. When I joined, it was it sort of defined me where I was actually really looking forward to it my whole life. So I was really looking forward to it. But the reality was very different to what was in my mind. So yes, someone thought I was their friend. Someone thought I was going to be their boss. Someone thought this is my colleague. Someone thought, okay, fine, I can say what I want. So it was challenging.
Yeah.
When I got more involved into it, and I realized that, listen, this is an extremely professional organization,
Mm-hmm.
and I'm like any other member in the organization, and I have to start at ground zero. And I think that's totally fair to do that.
Yeah.
The journey up to me was very, very different because I actually wanted to get a bird's eye view of the business. Mm-hmm. My whole objective, Sandeep, because I've grown up in a family business. I've grown up with entrepreneurs.
Yeah.
So my perspective has always been, I am going to be an entrepreneur.
Sure.
Because that's how I've grown up,
Yeah.
and I can't blame myself for that,
Yeah.
right? So when I put myself in working like a professional, it was very different to what the expectation I had.
Got it.
I think my father was very clear, saying that it's firm first, family second.
Mhm.
I think that was one part that he maintains till date, and for me it was, in my mind it was, I'm joining the family business.
Mhm.
So I think that's where the contradiction was.
Got it.
When I did that for 3 years, I realized that I'm not getting a perspective. I'm not getting a bird's eye view of the business. I want autonomy. I'm not getting a bird's eye view of the business. The business has scaled. So in my mind, it didn't matter if it was a 100 crore, 500 crore, 1,000 crore. That's not in my scheme of things. It was just that, I want to be where the action is, and I want to play a role in that, and I want to understand the moving parts of the business.
Sure.
Which I genuinely wasn't able to do, because the business had scaled so much that I was a small cog in that entire wheel. I was a small part in that entire in that entire organization. So I said, listen, this is not something that I really want, because I can't find myself here, and I can't figure out what I want to do, and where I don't know where I'm going.
And when this like push and pull was happening, like in your head, you've grown around entrepreneurs. Entrepreneurship was something that you would do at some point in time. And when you come into the company, you realize these contradictions in your own head. At which point did you say, okay, now let me start? Like, this happened overnight, it happened over a period of time?
Yeah, it was always sort of niggling for those 3 to 4 years where I worked there. It was always there, right? Saying that, listen, am I going to settle down? What am I going to do? How? And it'll happen to anyone in their journey, be it professional journey or be it when they're part of the family business. It's only natural, right? I mean, the distance between me and my father didn't even know what my designation was, didn't know where I sat, and didn't know who I reported to. So it was just very different, which is fair. I think it's fair for any large organization to have that.
Yeah.
But then to say that, okay, fine, what is my own learning journey? What is my progression? Because I think what I'm lucky enough to do, and what, as should any entrepreneur do, is the ability to take risk. That's what I've got going for me. I should be able to have a risk-taking appetite and have, I think, independence of thought process, because that's the luxury that I have, right? So why don't I take that? And then when I asked myself that question, I just gotten married. It was 2009 when I got married, and in 2010 I was out. Actually I didn't know what I wanted to do. So I spoke to my parents, and I could either do an MBA, I could either join another professional organization. I was only an undergrad, and I'm still only an undergrad right now also. Or I could start my own thing. So I said, listen, I think I want my own autonomy. I want to be my own boss.
Sure.
I don't think I want to work for someone else, because that's not what I've anticipated. And if I have the luxury to do that, then why not? So I discussed it with my parents, and I said, fine, I'll do something, but do what? I said, listen, all I've dreamt of is working with the family. So my father was like, here's your chance, work with your mother. So I didn't expect to work with my mom. I was expected to work with him. But she's a very passionate lady, and she loved, she had this hobby of soap making at that time, and we used to make soaps out of the kitchen.
Sure.
And I said, listen, I don't know how to do this, but hey, let's try. This is still we can get a mom and son shop.
Yeah.
And it's as simple as it gets. And from there, let's see where this takes us.
Yeah.
So start with the kitchen. From the kitchen, we moved to a small R&D. We took a little bit of help from Marico here and there, but just small help in terms of R&D.
Yeah.
And I sort of was off to the races, where I had a small cabin, and sort of, I had to start from everything from the 5 P's in marketing that you learn, packaging, place, promotion, people, the usual.
Yeah.
And from there, it was just, how do I get my MVP, my minimum viable product, in terms of actually getting the fit, the product market fit, from a perspective of who are my customers, what is the price point, where do I sell, and that was the journey which I started off on.
And like, how did that play out? How was the early days of like rolling the product out? Would you also go out in the market and figure out where the product placement should happen? Which are the distributors, retailers you'll park it with? Talk to me about that.
Yeah, I mean, at that time, the market was very different, right? This is like 2010,
Huh.
2010 to 2012. So beauty personal care really hadn't taken off back then.
Yes.
Not the way it has today, right?
Yes.
Today, every second entrepreneur wants to be a beauty personal care entrepreneur. Back then, that definitely wasn't the case,
Yeah.
right? And you know, there was no, I mean, online, whatever, and Amazon existed. Mica wasn't even formed then. Myntra wasn't there. So, I mean, there's no, I mean, so I'm not a D2C entrepreneur. I'm not digitally native. I actually started offline more than online, right?
Sure.
So we started with exhibitions. So as to go to these exhibitions where, you know, you'll have like the South Bombay women coming,
Yeah.
or you'll go to Bangalore, you'll go to Delhi, you'll buy a stall and you start. That's the traditional way to do it.
Yeah.
So that's how we did it.
So you would stand at those stalls and then talk to people about the soap?
Yeah, totally. Go stand, sell your product, you know, and be excited at the end of the day. Sometimes you made 20,000 rupees. Sometimes a big exhibition you made maybe 1 lakh, like maybe.
Yeah.
I can count on my fingertips number of times that happened, but literally like go do the stall setup, hire promoters, have your pitch ready, have the products ready, have take orders there, build your customer database. Then, you know, just talk to people about what your brand is, what it stands for.
Yeah.
Can you do birthday parties? Can you do large corporate orders? You know, it was as simple as that. And at that time, even like there was only general trade that existed. I mean, there was modern trade. There was a Trent, which is like a West Side, or a Star Bazaar, or a More that was there back then. But that was about it. There was no other real place that you could go because my products actually were pretty expensive, right? They weren't cheap. They were like 250 rupees for a bar of soap. But they were handmade glycerin soaps.
Yeah.
So they were the Lush of India.
Yeah.
If you heard of this UK brand called Lush. So it started just very, very simple, ground up.
And like now, if you look back with the benefit of hindsight, what were some of the learnings in that experience? Like, what would you have done differently or not at all?
Oh, for sure. I kept thinking, what am I doing? You know, what am I doing? I'm sort of, you know, going and selling soaps to people. Like, why am I doing this? And just to keep asking myself these, I mean, genuinely existential questions. So that why am I doing this? What am I really doing? Is this worth it? But what else would I be doing? I actually didn't have an answer to that.
Yeah.
What else would I be doing? I didn't know. But I think what it built in me was actually a sense of faith that I can do it myself. And it created another identity within me.
Sure.
I think with what happens to I think you know when I mean I'm lucky enough to have a father and mother like I do, but you know they were successful back then and they're successful today as well. So that they're like banyan trees, you know. So there's no shade under the banyan tree.
Yeah.
There's no shade. You can't go and create another. Trees don't grow below the banyan tree.
Yes.
Because there's no shade that comes there.
Yeah.
Right. There's only shade. It's only shade that comes there. There's no sunlight that comes there.
So
you need sunlight to grow.
So it's very hard for a new tree or a plant to come up under the shelter of a banyan tree.
Exactly. So it was my I would say journey to my metamorphosis, my journey to actually creating my own identity and creating my own personality, my own person, being my own person. If I hadn't done that, then I mean I wouldn't be sitting here talking to you.
No, absolutely. And I'm sure like it helped you grow as a person to becoming what you are today. And we'll get into that in just a bit. But even in the specifics of that business, like would you say that maybe the price point was too high relative to the market environment at that time? Or is it that challenges around distributing the product was an issue? Like if you were to zero in on that as a business case study, what would you say?
Oh, multiple. I mean, there were challenges across the board. But I think, you know, back then, you know, you always, of course, you're trying to create a category, right? There was no category like that didn't exist, right? A Forest Essentials and Kama or a Body Shop were just sort of entering, or they were just super premium, right? Between 2010 to 2015. So this is a long time back.
Yes.
And yes, they did have a solid brand as they do today. But I think, you know, just doing it ground up with, you know, I was completely bootstrapped. So it's not like I had like the best branding or even getting that product market fit. So yes, the products were too highly priced, and then that's when we pivoted. We said, okay, fine. There's no market for this because it's only some of this 1% or not even 1% of the population who will go and buy it. The soaps were so nice that people didn't want to use them. We was like, no, we keep it as a showpiece. We don't want to actually consume them.
I can imagine.
Like the different shapes, they're like these hearts, and they're Santa Claus, and they're like fruits, and they're like flowers and animals, and like it's actually it is like lush. It's very engaging as a category, but you can't get scale, you can't get volume and scale with that.
Right. And I suspect like there was this thing about India also, right? Like, and I guess that is changing. I read recently somewhere that in the West, people spend more money on the bedroom and the place where they live versus the living room, and in India people spend more money in the living room than on the bedroom, right? It's about what you want to show to the rest of the world, right?
Totally.
And this is where a personal care product where you're spending on yourself is not natural to Indians, certainly not then.
Totally. And back then, definitely not, as you said. But today, is that changing?
Yes.
Of course it is.
Yeah.
Today, we've got something where, back then also we used to have it, but we used to call it the shelfie. So you go to the customer's house, see the shelf, and see how the shelf looks, see what products they're actually consuming. And by and large, of course, it'll be the FMCG products that are there on the shelf.
Correct.
But now today, with overall awareness growing, with these platforms there, and with ease of transactions and delivery and everything, now people actually want more innate for themselves, for myself, rather than for showing. I think that's the big shift that's taken place, I think, in this decade.
Yeah, and to that extent, maybe soap opera was ahead of its time because people were still not spending on themselves at that point. And when did you then transition out of that business to running the family office? And I'll talk about that in a bit. But when did that movement happen?
So, in 2015, it happened very serendipitously when we went and we have this thing called the Marico Innovation Foundation, where we support social entrepreneurship in the country. And so there are innovators in the social space where we'll go and they'll write a case, and if they get selected, then they get to present to everyone, and we give them some grants, and we give them sort of a platform to
Sounds like a Shark Tank of sorts.
It was something like that. So I went on an audit to audit them. So I went to Kerala, and there was a self-help group that was doing stuff for women's health. And I saw, wow, there's so much, there's really exciting stuff they were doing in sanitation, and in for women's toilets, for sanitary pads, and there was just so much around the sanitation space. I'm like, oh my God, this is so phenomenal. Like, they're really doing impact. Like, impact is real and it's felt, and you're actually making a difference to people's lives. And I mean, that's what actually got me excited. I'm like, I went back, I'm like, wow, this is phenomenal. And they said, oh, you can actually invest in them. And that's when I was shocked. I was like, I didn't realize you could actually invest in a business and have equity stake. I'm not a finance, I've not studied finance in college. But that's when it dawned upon me that something like this is possible to do. And that's when the journey began, and I joined some angel groups. And then through those angel groups, actually, I saw a lot of entrepreneurs who were doing impact investing, or they were doing something for impact. It could be for profit or not for profit.
Sure.
But they were just doing something where it was, livelihoods, or something to do with health, or livelihoods, or energy, or whatever it was. But it was creating an impact in the lives of Indians. So I said, wow, this is fantastic, and you can actually take a stake. And that's when the whole journey began.
In fact, I remember this was probably mid 2010s, like 14, 15, when I think I first met with you. And you were one of the first formal family offices of sorts that had been set up, right? I mean, by then there were like 4 or 5 in India, but the concept wasn't very popular. You had a professional team running the portfolio, besides obviously working with some wealth managers. But how did that process happen? Like, how did you decide that this is the time for us as a family to create an investment team as opposed to taking all decisions yourselves?
No, I think that's great. I think, it was a journey that evolved. but I basically, our dividend ratio went up.
Yeah.
Right. So in 2015 we had liquidity which we otherwise never had, and my father's a true blue entrepreneur, so he believes, listen, I think Marico stock is doing really well.
Yeah.
I know Marico stock, it's going to give, it's compounded, whatever, 21-22% IRR year on year. So put the money back into Marico. It's simple. Why are you thinking about it?
Yeah.
I went to my father and I said, listen, I'm excited about this. I want to do stuff in VC. And by the way, do you want to invest in public markets? He said, listen, for Marico, it's, being in the listed space has been phenomenal in terms of wealth creation for shareholders and for promoters as well, of course. So I actually believe in the public markets as an asset class.
Yeah.
I don't believe in gold. I don't believe in real estate, but I believe in
public
markets. I said, great. Then that's when the debate happened between him and me, saying that he's like, put the money in Marico. I said, no, but you can't put all your eggs in one basket.
Yeah.
I appreciate it. You are this is what you've created, but you have to diversify.
Yeah.
So he said, okay, fine, we can diversify, but do you really know stock markets? I said, no, I don't know. I understand broad workings of stock markets, but am I a stock picker and do I have the excitement to do stock picking day in and day out? I don't. So I think it was through discussion with him that we realized that okay, fine, for the listed side, he was very clear that he wanted to work with few people and few people that he trusts, where we can build a portfolio up. So I said, great, I'm game for this, but as long as we diversify. So he was totally fine with that, and I think that was stage one of the journey.
Yeah.
Where we said there was the listed part of it, right? When you get the dividend, you have to allocate X amount to that.
Yeah.
And then there was the unlisted side where, I told you I was doing this. I was part of these impact investing groups.
Sure.
And then, someone pitched to us for another sanitation business in Bangalore, and my ex-colleague, but the two of us, Chaitanya, who you know,
yes,
we both flew down to Bangalore and we tried to see what this business was about. I understood how garbage moved from the home to the landfill, and I said, this is very exciting. And then we met the entrepreneur, and on the day we met the entrepreneur, he's like, are you going to invest now? And I was really stressed out. I said, my God, I have to give this guy an answer in one day. I've just seen the business. So Chaitanya was like, relax, you don't have to do that right here, right now. When you go back, let's think about it. And that's when we went and we did the business modeling, and we did the whole 9 yards in terms of thinking through how one can invest, and really I learned on the job. And of course we didn't invest in that, but then that led us to this entire journey that we had, right, where we first thought we'll do just impact investing. So we met a whole bunch of funds. My father invested in Bloom just out of a lark. Someone told him to put money in, and he did that. And this was their first fund. I think it was 2011.
I had the first Bloom meeting, I think, happened in the Marico office. I remember being there, and that time, I think your office was on Bandra Reclamation.
That's
and
right.
That's where, so Bloom was you were the early backers of
that's
Bloom.
Right.
And now
that's
it's obviously grown to become a much larger fund.
That's right. Yeah, it's done phenomenally well. And, we were there out there, and, we got a chance to meet entrepreneurs and have they had these things called Bloom Days, stuff. And that was very exciting to go interact with entrepreneurs and just see what was happening and understand what the fuss was all about.
But, I think about this, and these are large numbers. So Marico is today valued at nearly 70,000 crores at last count. It pays out dividends to promoters in the range of 300 to 400 crores a year. How do you deploy that kind of capital? Like, is there a framework for it that this is the asset allocation that you're running, or is it like more sporadic decisions that you're taking as you go?
I think we've had the wisdom, and it's borrowed wisdom from my father, but it is at least within the family that be disciplined in your approach.
Okay.
So just very, very clear guardrails. And don't do, I think initially itself, it's like, fine, you play, but you dip your toes, dip your feet in the water, but don't go in completely. Otherwise you'll be swimming naked when the tide goes, right?
Right.
So just go very, very slowly. So initially, it was 90-10, 90% listed,
Yes.
10% unlisted.
Got it.
And we did the 10% was a mix of funds and direct. And even the direct deals, initially it was, hey, this is someone who's doing it. Why don't you piggyback on them?
Yeah.
And that's when we learned what a term sheet was. That's what we learned what a shareholder agreement was.
Yeah.
That's when we learned what diligence was. That's when we learned to deal with the entrepreneur, how to help the entrepreneur, what to do, and what your rights are. And I think that process really helped us sort of decode and understand. It's an ongoing journey, but at least upfront we got some of that schooling and education through doing those deals. And we had done deals in very different industries. So everything from beer to even hardware for security devices to clinical trial companies. And I think that was the experimentation phase.
Yeah.
That from 2015 to 20 we did some of these deals. We did like deep tech funds, or tech funds. And of course we did consumer as well. But come around 2020, just when I'd sold the business. So I'd sold Pure Sense was the brand. I'd sold that, and I was full time into Sharrp, which is our family office. And at that time that's when we looked back, right? We had 5-year data, and we said, okay, fine, what are we really doing? Do we really know the companies that we're investing in, and do we have the right to invest in industries and categories that we don't understand?
Got it. So earlier you were more passive investor, sort of taking somebody else's lead on it, and then you decided that now it's time for you to sort of go deeper and select those companies more precisely.
Exactly. And even understand ourselves, right? What are we good at doing? Like 5 years was good enough of a time frame to understand, okay, fine, what are you good at? What do you enjoy doing? What's working for you? What's not working for you? What are the duds, or what's not performing? What's performing in your portfolio? And in those 5 years, we realized, hey, we actually, looking back, it's all in hindsight. Rishabh, I've been an entrepreneur for 10 years. My other colleague, Chaitanya, he had done through Marico, he'd done investor relations there. Of course, through the entire Marico also, in terms of the diligence that you can do or perspectives that you can have around the table, it's all consumer.
So, Rishabh, just taking a step back. So 90% was going into public markets.
Yes.
And 10% was at that time either private equity or venture funds, and some bit was individual deals. Even for did that 90-10 change at some point?
Yes.
What is it now today? Let's just start at 90-10.
Yes.
Where is it today?
Yeah, great question, because I think it's evolved over time.
Yeah.
I must say that it is a high risk portfolio, because we believe that our actually, for us as a family, this is a wealth creation journey. For the family office, it's the wealth preservation. So we like to call ourselves a river, not a pond. It's a river because I'm getting flow of capital.
Yes.
It's a pond if it's a liquidity event. If it's a one-time event, that's a pond. That's one pool of.
It is a river because every year certain dividend comes out of Marico, and that gets added to the Sharrp Ventures portfolio.
That's right. So, but to answer your question, Sandeep, the allocation has changed. So from 90-10, we moved to 80-20, we moved to 70-30, today we're at 60-40.
So 40% goes into unlisted assets today.
Yes. Yes.
Amazing. And this also means that the professionals that you need to run the family office probably also evolved over time, right? And for somebody who has a family office the way you do, or is thinking of setting up one, how should they create the professional team to run it?
Yeah, I think that's a great sort of way to think through things, and a great question. That journey has also evolved over time. And initially, it was just my colleague and I. It was very easy to do it. We just got along really well with each other. We had great chemistry. We got great comfort with one another. We had deep trust with one another, and that's how you start. You enjoy what you do. You like what you do. You do that with people you enjoy, and magic happens.
Sure.
Luckily, in our case, we've got the fortitude, the luck to actually have one or two good deals that have really done well. Of course, there's a journey for the others as well, because this is a long-term game. But coming to your point, in terms of, I think, when we were started to where we are today, I think that needle has shifted in terms of the talent and the skill set that one has. What got you there today can't be the same at present, right? what got you there.
So when the portfolio was 90-10, it needed a different sort of talent. Now that it's 60% in public and 40 in unlisted, needs a different talent pool.
Exactly.
Okay.
And so today we've got very different. We've got a much larger team for the unlisted. We've got investment professionals and we've got operators. So I think what founders need today is they don't need just investors who understand business modeling and who can do Excel sheets and who are CAs. Yes,
Yeah.
you do need that,
Yeah.
but you also need operators.
Yeah.
And so I think we've been very conscious and very thought through in terms of who we want to get on board. So recently we just hired a very senior resource. He's a partner who's come on board and he'd got operating experience at another fund. And then he took a company to IPO as a CEO of the largest wine company in the country. And today he's just come on board. I think that's one big move that we've made. I think before that we've created an LTI policy, so a long-term incentive policy, which is similar to funds, where there's a carry structure involved. But however,
So the team gets a share of the upside.
they get a team of the profits, right?
Yeah.
But I think the difference between a family office and a VC is that a VC has a they've got an investing journey, and then they've got to reap those investments and return money to
So
investors.
VCs are managing other people's money, so they have to return that money at some point of time.
Correct. And that point in time is the question.
Yeah.
So because we're in the consumer space, we believe that consumer brands actually have a 8-year journey, 10-year journey. Brands take time to get built. And we've seen that in Marico, in Kaya, in Soap Opera, in Pure Sense. We've seen that.
Yeah.
That brands don't get built overnight, and it's a journey. And for that, you have to have long-term patient capital. And that's what we are.
Yeah.
Because I don't need to return money to my investors. My investors are my mother, my father, my wife, and my kids.
Yeah.
Luckily for me, I don't have to return money to them.
Yeah.
I mean, I do at some point, but not at the same time horizon as VCs do.
Yeah.
I think that's the strong, that's the differentiator that actually family offices have. Long-term patient capital.
Rishabh, this seems like a lot of effort, like to run a family office. It seems like you have a bunch of people figuring out where to invest, when to invest. At which scale does it make sense to create your own family office?
Yeah.
Because I'm sure you'll get asked this question a lot from your friends. We get this question from a lot of clients. What do you think the right amount of money is? 250 crores, 500 crores, 1,000 crores? When do you think it becomes viable?
Yeah, I think that there are 2 or 3 things that one needs to think about, right? One is just the assets under management, as you said, right? The AUM, which is that, what is that right number? I think that's one part of it, which I'll get to. But I also think it's most promoters today are running their own businesses.
Yeah.
So then I think the question that I actually ask them is that, okay, fine, how much time are you willing to invest? Because you're busy running your business. How involved are you in your investments? One. Two, do you have time? Would you have the ability to give time? Because
Yeah.
I do this almost full time. This
Yeah.
is my day job.
Yeah.
Right? My day job is not operating Marico, operating Kaya, right?
Yeah.
There's a professional management out there. That's not my day job. My day job is this. This is what I do for a living.
Sure.
So I think that those are aspects that people and folks who are thinking about this actually they discount, and I think that's critical to get.
So this is investing or running your portfolio as a full-time activity, and it needs to be looked at as such. So that's the starting point, that if you want to be serious about it, you need to get professionals to run it or somebody dedicatedly handling it.
I mean, of course, yes, that's one, but you can't say that, listen, I'll give 5% of my time. If you're giving 5% of your time, then do stuff that don't do cocktail conversation deals.
Yeah.
Don't do cocktail conversation startups, because that's the slippery slope.
They're called party rounds. Like everyone is participating in a round because their friend is participating.
Yeah, it's FOMO. It's fear of missing out.
Yeah.
Oh wow, I'm doing this deal. Oh wow, you should come in here. This is really good. Who's telling you that? What are the diligence they've done?
Yeah.
How do they know the entrepreneur? Have you met the entrepreneur?
Yeah.
Have you done the diligence? What are the terms? And it's a journey. I'm not saying everything needs to be perfect on day one, but there should be some line of sight out there in terms of thinking this through, right?
Sure.
Everyone makes mistakes, and that's how you learn.
Sure. And that's a great insight that, this is not a side activity, not something that you can do in your part time, but something that needs to be structured and done well. You've created a structure around the portfolio. And to the first question, like how much do you think is the amount of money it needs before you should do this?
Yeah, so I think, it just really doesn't make sense when you do it. It has to be above 100 crores. Anything above 100 crores makes sense.
Okay.
I think below that, you just be present in funds, right?
Yeah.
Go into funds where, you learn from them, because, with promoters and with owners, rightfully so, they're so busy doing their day job that, having the time, energy, effort to even understand when an entrepreneur comes and pitches to you, or why you should be doing a deal, it can't be FOMO. It can't be because my buddy told me this or my friend told me this. What is your homework that you've done out there, and why do you believe that this deal is good?
Makes sense. And Rishabh, you mentioned that you also are LPs or limited partners or investors in funds, right? And since you're an active investor yourself, how do you evaluate funds? Like, is there a framework or a thought process you have that 1, 2, 3 things that you would check before allocating money to a fund?
Yeah, 100%. We've been a bit unique in terms of saying, by and large, most of our investments are all first-time fund managers. Around 90% of our investments are all first-time fund managers. We don't have any. We have 1 or 2 funds which have where they've done funds before. But that's like recent of late.
This is very counterintuitive, because normally people would say, like, let the fund manager establish, do the first fund, returns aayenge, and then once that's good, then I'll invest in the second fund. Why are you doing this thing the other way around?
I think it was by default. We just didn't know better is the true answer. It's panned out in some cases, it's not panned out in some cases. So in the cases it's panned out, it's been any consumer fund that we've done, that's done well.
Okay.
Any tech fund that we've done, not done that well.
Okay.
So because again, what is the right that we have to diligence tech?
Sure.
Do I understand tech? I genuinely don't. And I have no qualms in saying that, and I want to focus on consumer because that's what I get. So we've been, I would like to think that we've been disciplined in terms of where we're putting money. But yes, we went to first time managers because A, we didn't know better. B is that I think that was our own learning journey, right? I think, we also learned then, and then we figured out what we liked, what we didn't like. But I think, yes, the criteria which I think one should look at, that we look at now actively today. I mean, we've got like a whole checklist. But really, I think, the founder friendliness, how founder friendly are they? Are they there? I think I'm picking up one of these lines from a fund, but are they there in good times and bad for the founder? What is the level of, if they're doing too many things, like in too many sectors, I think what is their depth? What is their value add? Right? Otherwise, why should founders choose them? Today, we're in a space where there's money chase, there's capital chasing founders, not founders chasing capital.
Sure.
Yes, you have those funding winters that come and go, but the reality is that the right founder can get capital very quickly.
Yeah. So founder friendliness and the depth in that particular industry or sector that the fund is investing in.
Yes, and any conflicts. You want to be very sure of the type of person you're dealing with, the chemistry, the truly understanding them, the individuals who are there, or even the partnership. If it's usually most funds is a partnership, because sole individual really can't. There's a lot of heavy lifting required in funds, and I mean, every fund that you invest in, it's always been a partnership. It's not just one individual.
Interesting.
Yeah.
And Rishabh, how easy or difficult is it to attract talent to work at your family office?
Yeah, I think it's tough.
Yeah.
I don't think it's easy. And I think one has to, that's why one has to make it a place which is conducive to getting the right talent and the right quality of professionals on board.
And the long-term incentive is one element of that.
It's one aspect of that.
Okay.
But those same professionals would ask, fine, why you? Why not a fund?
Yeah.
Or what are you adding to my journey? How are you adding to my journey? How enriching is it? surety of capital. Why will deal flow happen from here, or what is the brand? What is the brand that I'm representing about? All those things matter.
And are there times when you disagree with an investment being recommended, or is there like that kind as owner and running the family office also?
100%.
And then how do you resolve those tiebreaker tests?
Yeah, so that's happened already. It's happened twice in the last year, and the team they've suggested deals, and they like the founder. We did the diligence, and I was okay for the diligence. And then there's what we call deal thumping. So you thump the table in terms of high, medium, low.
Yeah.
And it's not decision making is not one way. It's across the table.
Sure.
So the team had a lot more conviction in the founder and the business, and the rationale that the pushback I couldn't have. I was not comfortable with the investment, but I didn't have a good enough rationale to why I didn't want to do it. And so I said, fine, I generally I'll agree with you. I'll agree to disagree, agree to disagree and commit.
Yeah.
Okay. Agree and disagree and commit.
And that's hard, given that in a sense it's your family capital, and it's not like, and therefore even in spite of that, you doing that is incredible.
I mean, I think that's the path to truly building a world-class organization, and where decision making is not just from it's more sort of structured decision making rather than just controlled and very centralized.
And when I've seen Harsh, your father, talk, this comes out even in the context of Marico, where there's a professional team and there's a lot of independence that the team has in terms of running the company also.
Yeah, and I think, genuinely, if it wasn't for how he's built the business and how he's the culture that's there in Marico, and the thought process and the autonomy that Mariconians and the teams have, I don't think I'd be doing what I'm doing in the manner I'm doing it today. So it's from the modeling that's been there through Marico and through him that I'm doing what I'm doing right now with Sharrp.
Yeah, very interesting. Rishabh, when you Google Rishabh Mariwala and Sharrp Ventures today, you will get things like 35x return on Nykaa, 50x on Mamaearth. I think you're one of the best individual professional investors in D2C brands, like the way I think about it today. What sort of created this unique insight of investing in D2C? Like, how did you get to start focusing on this particular segment of the market?
Yeah, so it was not, again, it was just, I think, right time, right place. It was, I think the thought process was digitally native. We wanted digitally native entrepreneurs.
Okay.
I think D2C, it's turned out to be a D2C sort of narrative. But the reality is that we weren't too concerned about it being marketplace, platform, or just D2C where they've got only chops on their website and how they're building their own brand on their website. So it's sort of, we've caught that trend of D2C, but the intent was not, we just want to do only D2C. Okay. I think, today also, the world is moving where D2C, to a certain limit, it's great, but you have to move offline. Omnichannel is critical. We understand offline more than online, if you ask us.
Yeah.
Yes, we can we decipher online? Can we decipher D2C and how brands are doing and where they're moving and what is the potential trajectory and growth? Yeah, we can. But I think we actually leave it to the entrepreneur. When they're digitally native, they actually get that way better than we do.
So you're saying these are actually consumer brands,
which
one channel is D2C, the digital channel, but now you also guide them and help them in terms of building the offline channel. And when you think about these new age consumer brands today, Rishabh, and there are a lot of them springing up today. When you watch Shark Tank, one of the most common things that comes up there are these new age consumer brands. How should you evaluate a new age consumer brand to invest in? What are, give me a framework to help us think through this.
Yeah, I think there are a couple of points and there are a lot of articles out there that have been written. But what we look at, few of the things we look at is what is the returning customer, right? What is the repeat customer?
Okay.
And what's been the trajectory of repeat customer in month 6, month 12?
Sure.
And are they high double digits, like 20, 30, 35%?
Okay.
growth
Okay.
of the same repeat customers.
Okay.
Right. And that's critical. I think even, over time, one has to look at, I mean, depends on the time of the investment, but, capital efficiency is critical. So, I think gone are the days where there was just only money thrown at the entrepreneurs and where the burn was okay. Now, I think, one, capital efficiency is critical.
Yeah. So at the unit economics, how much money are you making or not? Yeah.
Yeah, unit economics is critical.
Yeah.
And are you? I mean, yeah, it depends on the stage, but if your EBITDA positive or slightly negative, that's still okay if you're at early stage.
Sure.
But at some point, yeah, you
There
can't.
has to be visibility of.
Visibility or break even at some point in time. Now, I'm not saying that at a 50 crores you have to break even. I'm not saying that.
Yeah.
But can you be negative, whatever, 50-60%? No, you can't.
Yes.
So, how focused is the entrepreneur on that, right? How much this? So I think unit economics and EBITDA is critical.
Sure.
But even capital efficiency. So how much money have you raised versus what are you? What's your ARR? Right. I think that's also like critical, right?
Sure.
And I think the third thing is, how much you're spending on brand building, because you can't just, if you only spend on performance marketing and not on brand building, I think that's a, I don't think that's the right way to build, because brands are about brand memorability and top of mind recall, and I think it's just critical that brands get their due, not from a how much am I spending on performance marketing only, but just on category creation or on brand creation.
That's very interesting. So you're saying repeat rates, capital efficiency, and how you're building out your brand, right? Yes. One of the things I think about a lot, Rishabh, even in the context of our own business, is how efficient is brand building, right? Because it's money that you put out there and you don't necessarily get immediate outcomes for it. It's something that gets built over time. What have you seen companies do really well in this category? Because new age consumer brands, a lot of it, like you rightly said, is about how they built out their brand perception.
Yeah. I think, it's a longer journey, right? And the trick is, especially when you're deploying that money, you don't know, okay, you'll ask what's the ROS, what's the ROAS, or what's the return on that, what's the ROI on that spend, right? And of course, that's going to be a question that everyone's going to ask, and you're wondering, is that going to come back or not? But I think there are ways to do that, especially in the consumer space, in terms of brand recall. You can do brand tracks and you can do brand studies to figure that out. But I think over time, we've seen that, right? That depends on the category and depends on the space. But say when you go, for example, when you go offline, for example, right? And I think the brand has to be of a certain scale to go offline. You can't go offline at a 50-100 crores. But say the business is sort of, growing month on month, 20-30% month on month. You've got cash in the bank. You've got a runway. Your online is sort of, slowing down to 10%. You're growing, but it's tapering. Then you say, fine, let me move offline. Then for offline, you're saying, okay, fine, what do I need to do to disrupt offline? So, I mean, I'm not suggesting this for everybody, but this is a playbook that brands use. Is okay, fine. How do we influence trade? So influence trade. Okay, so what is the right time to get a celebrity on board? So the celebrity actually doesn't. It's not for the customer. It's for the trade. It's for the retailer. It's for the distributor.
Got it.
Wow. Alia Bhatt, oh wow, Deepika, or whoever, XYZ, or Ranveer,
That's interesting. So you're actually not convincing the end customer, but the intermediary who will take your product to the end customer.
Exactly.
Okay, that's an interesting insight. I didn't think of it that way, and it makes a lot of sense because they are the one who are on the point of purchase going to nudge the customer to buy your brand versus the other.
Yes.
Yeah. And I remember this actually. Cadbury's did this very interesting campaign with Shahrukh where they created a campaign where Shahrukh was pronouncing the name of the dukaan where you're buying Cadbury's. It was a Diwali campaign. No, very interesting, and this makes a lot of sense. A lot of new age consumer brands are emerging in India, Rishabh, and I wonder what it takes to succeed in India today. Right, in the new India that is getting created, where people are getting more affluent. Or rather, I'll put it the other way around. Why do some consumer brands fail What are the things that they get wrong?
Yeah, sometimes it's just I mean, there are a plethora of reasons, right? And there's not one single reason, but sometimes your product is too niche, and actually I think sometimes niches are really good because
Yeah.
you can build that niche out. So it's about the decoding the customer. I think decoding the customer is critical because is there a real need? Why does this product exist, and what is that product solving that other brands are not able to solve? Right?
Sure.
What is it doing? I think that's a critical reason. And does the world need another shampoo or a soap or a water body? It doesn't.
Yeah.
But are you what emotional need are you addressing, or what pain point problem are you solving for the customer?
Right.
I think if you answer that, and there are enough people out there, and that's half the journey in terms of figuring out when is there enough need for that. And that's why most brands keep pivoting, right? Pivot is natural. It's going to
Right.
happen because you're learning on the job. You generally don't know the answers. You're in search of that answer.
Yeah.
And once that click happens, that's when you're off to the races.
Yeah.
But before that, it's always iteration, right? It's always iterating.
So figuring out whether there is a pain point that the brand is solving, are there enough people buying it, and will they pay for it?
Yeah.
I think is really interesting.
Yes.
Rishabh, this has been excellent. I've really enjoyed this conversation. I think we've taken away a lot of things on how you run your family office, your own journey, and very importantly, this whole D2C space that is emerging in India right now. Thank you so much for doing
Awesome.
this.
Thank you so much. Thanks for having me, Sandeep.